Good afternoon, and welcome to Steady Partners Q4 2025 Market and Economic Outlook webinar. I'm your host, Tom Cohn, Steady Partners Chief Solutions Officer, and I'm joined by my colleagues, Jim Leventhal, Chief Equity Strategist and Partner in our New York office, and Amita Schultz, a Partner and Portfolio Manager in our OCIO practice. A couple of housekeeping announcements before we get into the presentation. One, we will not be taking questions today. We've received a number of questions that we've woven into the presentation today, and hopefully we'll answer through the commentary of Amita and Jim. If there are any questions that we did not answer, please reach out to your Steady Partners advisor. We will be prepared to answer those in more detail. In addition to the presentation, which will be available after the call, and a recording of the webinar, which will be available early next week. A number of the topics that we're going to touch on today, we have additional, more detailed content on our website at SerityPartners.com if you would like more information, or please reach out to your Serity Partners advisor if you would like a copy or a link to any of our additional material and collateral. With that, we'll get into the presentation. 2025 has been an extraordinary year filled with market volatility, but also market strength, with the markets up over 17% through Q3. Today, Amita is going to take us through the economic backdrop, which in a lot of ways remains strong, although there are risks emerging to the labor market. And Jim is going to take us through what's going on in the equity market, including a topic we've covered on our previous webinars, concentration risk, as few as another risk that are emerging within the market in credit, and touch on the debasement trade. Putting it all together, our outlook for the market remains resilient. We see pockets of strength bolstered by the AI spending and AI productivity boom, and government policy, both spending due to the One Big Beautiful Bill Act, as well as Federal Reserve policy turning accommodative. That being said, there are risks that are emerging that we will touch on through the duration of this presentation. With that, to take us through what's going on in the economy, I'm going to pass it to Amita.
Thanks so much, Tom. We're going to stay on this slide for a little bit. Many of us are gearing up for the start of the holiday season, and the equity markets, as you alluded to, are certainly providing a good amount of cheer. As you look at the left side of this page, you'll see third quarter returns for major asset groupings listed from highest to lowest. And the first four bars are all equity markets. Within the equity markets, we have seen a bit of a turn of events, with small cap starting to perform very well in relation to other areas. Small cap was the best performing area in the third quarter, followed by emerging markets equity. And you'll see real estate, commodities somewhat in the middle of the pack, with all of the fixed income markets towards the bottom, along with cash. On a year-to-date basis, which you'll see on the right-hand side, emerging markets equity has been the best performing area by far, up a whopping 33% for the year thus far. International equity is also up there with its positive 27% return. I think it's worth noting that both international equity markets being at the top reflects quite a bit of a rotation from what we've seen in the market in prior years. You might recall in 2024, international equity underperformed U.S. equity by about 20%. So far this year in 2025, international is outperforming the U.S. market by about 9%, a very good example, I think, of why it's prudent to stay diversified. Another strong performing area this year is commodities, up 12.5% through the third quarter. This on the back of gold, which has seen significant interest due to fears of debasement and buying by central banks. In the fixed income space, you'll see high yield bonds have been the strongest performing area so far this year, up 7.4%. Spreads have increased a bit in the past couple of months, but are still at the low end of their historic range. Now let's take a look at some macroeconomic data on the next slide. I'll give you a handful of punchlines before getting into the details here. First, the U.S. economy remains resilient as measured by GDP growth. Second, there are signs of a softer labor market, which is translating into slower, albeit still positive trends for consumer spending. And third, CPI remains sticky at around 3%, though we're still starting to see some signs of the impacts of tariffs on goods inflation. Worth mentioning, the One Big Beautiful Bill Act is expected to provide stimulus to both individuals and corporations in 2026. So I'll be speaking about that as well. But first, let's turn to GDP right here, the big picture. I'm happy to report that for now, U.S. economic growth is back on track, and we continue to see resilience in the U.S. economy. The ultimate effects of tariffs remains to be seen, but in the second quarter, U.S. GDP rose at a very large 3.8%. This was led by a 1.7% advance in consumer spending. We also saw a large drop in imports, not too surprising. You may recall that businesses front-loaded inventory in the first quarter in anticipation of new tariff announcements. But in that way, the strong second quarter GDP growth rate was essentially a recovery from a slightly negative print that we saw in the first quarter. So if you look at the first half of 2025 together, first quarter and second quarter, you see that we're roughly in the long-term trend growth rate around 2%. Third quarter GDP has not been officially released yet due to the government shutdown, but indications show continued momentum. The Atlanta Fed puts out a very good forecast called GDP Now, that's showing a rise of a positive 4% for the third quarter. And we anticipate that consumer spending is going to continue to be healthy in the fourth quarter, driven really by the upper income portion of the population. They've experienced higher wages and the wealth effect, meaning that they've seen an appreciation in both their financial assets and real estate portfolios as well. Capital spending should also be a notable growth contributor in the fourth quarter, especially related to intellectual property investments, such as investment in equipment and software to run AI applications. A tangential AI investment spend is also occurring, which we've seen over the past couple of quarters in power generation and data center spaces. But thinking about the fourth quarter, overall economic growth is expected to be, as I said, at a roughly 4% level. There are some offsets that we should be thinking about, which I'll get to in just a moment. On the next slide, though, we want to talk about AI in the context of GDP growth. While consumer spending has been at healthy levels, it has been lower in 2025 than we had been seeing in the second half of 2024. And as consumer spending has slowed, AI infrastructure spending has been filling some of the gap. In the orange bar, you'll see non-residential fixed investment on tech structures and software. Jiva's going to talk much more about AI a bit later, but for now, I'll just point out that AI CapEx is a serious part of the GDP growth story in this country. It accounts for 0.8% to 1.3% of GDP growth over the past 2 quarters. One big question that remains is the impact of the government shutdown. The current shutdown is at 37 days. That's the longest in U.S. history. But before this one, the longest government shutdown was just 34 days, which happened in December of 2018. It's important to bear in mind that the average shutdown is just 8 days. So we are way beyond the average shutdown at this point. And there's been a lot of news about shutdowns not having a material impact on the economy. That information is usually based on historical analysis of shutdowns, which, as I mentioned, average about 8 days, not 37 days. The longer the shutdown lasts, of course, the higher probability that it's going to have a more meaningful impact because there are so many direct and indirect impacts that we need to be thinking about. But we're already starting to see some of those. Federal workers are furloughed without pay now for a number of weeks. They have no money coming in unless they've taken on side jobs or gig work. Their household income is reduced, and one would imagine after several weeks we'll need to start seeing changes in spending habits. Government contractors and suppliers also aren't getting paid. That's another group of workers that have seen a meaningful slowdown in cash flow and will have some impacts on consumption. And now the FAA has announced air traffic is being reduced by 10% at 40 major airports around the country. TSA and air traffic control staff are still working without pay, which is quite unfortunate. So after 37 days, the shutdown is reaching a point that it's having an effect. What the effect will be in aggregate is yet to be seen, but we'll have more on that to come in the coming months. One effect that we have been feeling in our own work relates to the shortage of labor market data. So we can look at the next slide. There has been limited amount of labor market data due to the government shutdown. The Bureau of Labor Statistics is not issuing initial weekly jobless claims as it usually does. There is some state reported information available. So we've used that to pull all this information together. Federal government workers are included in the state level data. However, so it's a partial data set, but we think a fairly robust and indicative one. And what we're seeing with all of this state reported data aggregated together is that weekly initial claims still look fairly low for now, and continuing claims have completely rolled over. So the data looks good all in, given what we have, but we know there are some cracks. You've likely read all the headlines as we have. We've seen mass layoffs in places like Amazon and UPS, Microsoft, Salesforce. And we also know there is some fraying along the edges, meaning there is weak job conditions. It's very difficult to get a job for recent graduates, for example. We do anticipate that higher labor costs from slower population growth and more restricted immigration policies are going to play a role in all of this as well. There may be some signs of relief, and we start to see this when you look at the ADP data on the next slide. Given the hole in the employment data left by the government shutdown, ADP has come out with a weekly estimate to fill in the gap. So this is week over week change in employment. You can see July to mid-September looks somewhat weak, but we're starting to see an uptick in more recent weeks. So it's a bit of a mixed picture with limited labor market data at this point. We do have firm data on other economic metrics, however, like inflation with CPI. Thanks to the cost of living adjustments for next year's Social Security payments, the Bureau of Labor Statistics did release this information. And you can see that headline CPI continues to be at 3%. There are some interesting dynamics at play within the subcomponents. However, what we see very clearly, tariffs are showing up in goods prices. It's not severe, but it's unmistakable and present. The dark green line at the bottom show that there have been areas that have been impacted, and it won't surprise you. Clothing, shoes, jewelry, TVs, audio equipment, sporting goods, all affected by tariffs. At this point, we have a 1.5% year-over-year change for goods prices. That means we're doing, okay on tariff inflation for the time being. But what we're also seeing in the subcomponents is that there's a commensurate decrease in shelter inflation. That's the dark brown line. And the decline in shelter inflation is thanks to falling rent growth, slowly getting incorporated into the data. Inflation for other services is running a bit higher as it typically does. There was a brief bump up over the summer, but that appears to have dissipated in the current print. But in aggregate, the rise in goods prices is being offset by a decline in shelter, and headline CPI remains at 3%. Some of you may be thinking CPI seems to have been at around 3% for a while now, and that is correct. It's been fairly sticky and hovering around 3% for almost 2 years. However, the final chapter in the inflation story, we believe, has not yet been written. To date, the impact of tariffs on prices has certainly been less pronounced than some initially feared, but that may be because corporations are sitting on healthy profit margins, and they had healthy profit margins coming into the beginning of the year through the tariff announcement, and they have been willing to absorb some of the higher input costs for the time being. But we wonder whether their willingness to do so has some limitations. So the ultimate effect on tariffs on businesses and consumers is going to affect GDP growth. One counterbalance here may be the wealthy consumer. Wealthier households continue to be the biggest drivers of consumer spending. This cohort has seen sizable wealth gains, as I mentioned before, thanks to equity markets and home prices. They will also receive considerable support next year from tax legislation in the One Big Beautiful Bill. So let's talk about that next. You'll see the effects of the One Big Beautiful Bill on the individual side. First here, 2026 tax refunds will likely be larger than normal. Additional tax cuts under the bill are retroactive to the start of the year, but the IRS has not altered its withholding tables. So we anticipate strong refund issuance during the 2026 filing season will enhance the wealth effect to the tune of about $150 billion worth of new money coming back in the form of refunds. So forward-looking withholding changes will also be made, and after-tax income should increase next year, especially in the first quarter when we see this large fiscal stimulus influx due to refunds. The bill also has meaningful implications for corporations, and we can see that on the next slide. The bill was passed on July 4th, and it was in effect immediately for corporations. $100 billion of business tax cuts have been distributed to companies You can already see the change in trajectory of corporate tax payments. September 15th was tax day for corporations. Tax receipts by the US government have been lower in 2025 than they were in 2024, even though corporate profits have been higher in 2025 than in 2024. So companies are making more but paying less in taxes. And there is this more immediate impact on the corporate side than on the consumer side. But when we think about the bill in general, it seems to be very front loaded. Benefits are concentrated in 26 and 27. After that, spending cuts are supposed to kick in and deficit impacts will start to tail out a bit. But the bill is really meant to provide an economic uplift in 2026, and we anticipate that it will do that. Worth noting that additional stimulus could also be coming for corporations. If the Supreme Court mandates refunds for tariffs paid, that would mean another $200 billion of payments to companies in 2026. Now, the Supreme Court just started hearing oral arguments on the legality of Trump's tariffs yesterday. A decision is expected later in the year or potentially in January of 2026. So more to come on that front as well. Now let's shift gear a bit and look at the fixed income markets and the yield curve. The 10-year is at 4% at its lows on the year. Current and prospective monetary easing drove a shift down in yields during the third quarter, despite surprisingly strong economic growth and lingering supply pressures. We've seen some steepening of the yield curve in the 3-month T-bill range, falling more than the 10 and 30-year maturities. What had been the longest curve inversion in U.S. history is slowly starting to fade away. And very importantly, the demand for U.S. treasuries among both domestic and international purchasers remained very strong during the quarter. So the U.S. is still viewed as an attractive bond market. Fortunately, broad credit conditions seem reasonably healthy as well, even with some of the recent high-profile auto and commercial real estate-related stresses in regional banks and financial institutions. But the state of the credit markets, labor markets, inflation, GDP are all being examined by the Fed very closely, as you might imagine, and have impacts on the equity markets. I'm going to pass it to my esteemed colleague, Jim Leventhal, to tell us more about that.
Amita, thank you very much, and welcome everybody again. I'd like to start on this slide. Amita started her presentation showing that many markets, and especially equity markets, have had fabulous year-to-date returns. But as Tom noted in his introduction, this is a rally that once again has become very concentrated in technology names for the third year in a row. And this chart shows that. If you look all the way to the left at the technology sector, we can see in the teal-colored bar that technology is once again having a heck of a year. And the 3 months ended October 31st were a major contribution to it. But as you look further to the right, what you see is not every sector is having anywhere near as good a return. The ones that are having good returns are communication services, many of which are tied to the artificial intelligence trade, and utilities, which are powering, literally, the data centers that are the backbone of the artificial intelligence trade, and industrials, which are building those data centers. But as you look further into the various sectors, you see there is a rotation going on. So for instance, take a look at financials. Year to date, they are up 9%, but they've done absolutely nothing over the last 3 months. That may well be an indication that the government shutdown is having an effect. Certainly with the government shutdown, IPOs are delayed, regulatory approvals of M&A activity are delayed, so that could be having an effect there. And it is nice going a little further to the right to see something like healthcare claw back from an early year decline and put up an 11% return over the last 3 months. But that and discretionary really seem like outliers when you look at the rest of the non-tech returns over the last 3 months. Energy, materials, real estate, consumer staples, all kind of doing not so well. But the market overall is doing well, again, really powered by that artificial intelligence trade. Now, will it go higher? And will the rally broaden? Let's start to dive a little bit deeper into the opportunities and risks that we see ahead, starting with the Federal Reserve. which on the next right there, thank you. The Fed is going to cut interest rates. Now, there are debates about whether they should cut interest rates, given that inflation seems to be sticky around 3%, a full percentage point above the 2% targets. And there are meaningful and legitimate concerns about the independence of the Fed, given ongoing attacks on the Fed by the president. But putting those aside, the simplest thing to say is whether it is market expectations or the Fed's own projections, there are further rate cuts coming. And that is a powerful tailwind for equity markets. The old adage, don't fight the Fed, is really quite often, almost always true. Going further on into what is really powering the economy, really powering the markets, it is, as we've mentioned, the artificial intelligence trade. Now, there are questions that are brewing about the artificial intelligence trade. Is it a bubble? Is it real? Can it continue? What about this debt financing that's been going on? I think the numbers on this page tell a good deal of the story in answering those questions. These are the top top five, we've got to include Oracle these days, hyperscaler companies and their planned announced capital expenditures over the next few years. This year, it looks like it's going to come in just below 400 billion. Next year, above 450 billion. By some estimates, it may even go as high as 500 billion. These are very big numbers. These are very big numbers to insert into the economy, which will in turn have a trickle-through effect to those other sectors that I mentioned, like the utilities, like the industrials, eventually to energy and materials. So this is a very powerful force within the economy and within the markets. To answer some of the questions, or at least try to answer some of the questions that have arisen, starting with the circular nature of some of these business arrangements, whereby, for instance, OpenAI, one of the large language model producers, contracts with Oracle to build data centers. Oracle then builds data centers using NVIDIA chips, and NVIDIA turns around and invests in OpenAI. Yes, that does form a circle. It's important to note, however, that each transaction along that circle does have profitable return on investment happening. So it is, at this moment, a virtuous circle that looks like, on the back of these numbers, it will continue for some time. There are also, as I mentioned, questions about how is this being financed. And we're seeing debt offerings, not just yet, please, if we can go back. We're seeing debt offerings measured in the tens of billions of dollars from companies that have traditionally not used a lot of debt, like Meta, for instance, or Oracle. I would point out that for the dollar value of investments that we are seeing here, measured in the multi-hundreds of billions of dollars, having a few tens of billions of dollars of debt financing is actually pretty conservative, because the rest of this is really coming from internally generated cash flows. And from a corporate finance point of view, it probably makes sense to use lower cost of capital debt as opposed to equity financing for that small portion of these investments that isn't being funded by internal cash flows. So all in all, we're not worried at this point about the circular nature of the trades that are going on. We're not worried about the debt financing, and we don't think that it's a bubble, at least not yet. And in part, that is because while much of the data center focus has been in the US, it is rapidly expanding abroad, as we show you on the next slide, which shows the number of newly funded artificial intelligence companies, not just in the United States, but also in Europe and China. And I should point out that this does not include the very important Middle East, where, for instance, the Humane Company in Saudi Arabia is very rapidly building data centers, as well as the United Arab Emirates. So the global nature of the data center build-out, the capital expenditures for the artificial intelligence backbone, is going to continue to promote its rise over the coming quarters, in our opinion. What is also going to promote the continuance of the artificial intelligence trade is the low degree to which companies thus far have actually used artificial intelligence. And that means that there is unpenetrated opportunities, as we show on the next slide. This is a survey that comes from the U.S. Census Bureau that asks businesses how much have they used artificial intelligence and how much are they planning to use artificial intelligence. Now these, to me at least, are very low numbers, and they indicate that the use cases are still coming, still to be created from artificial intelligence. I don't think it's a case where we have topped out. I don't think it's a case where those use cases will not show up. It's just a matter of time and will likely justify the continued AI trade. Now, again to this question, is AI a bubble? Well, let's compare it to what was the quintessential bubble, which was the late 1990s. And what we show on the left-hand side here is a chart of the price-to-earnings ratio of Cisco during the late 1990s versus NVIDIA today. Both companies were certainly the bellwethers of their time and of their prevailing industries. So Cisco being the build-out of the internet, the build-out of the digital age. And as you can see on the chart, by as late as mid-1997, it was trading at just below 30 times forward earnings. It then, over the subsequent 2 years, shot up to about 120 times. That's a bubble. That's a bubble. It popped. It came back down. It was very painful. But I'd like you to compare that to the forward price to earnings multiple on NVIDIA, which, while choppy over the last few years, is certainly at a level that's more commensurate with Cisco in 1997 than it is with Cisco in 1999. And given the fact that estimates look like NVIDIA will grow its earnings at roughly 30% over the next year, that roughly 30 times multiple does not seem expensive to us. Now, I've talked so far about some of the things that are positive, some of the things that we see are opportunities in the market. I'd like to talk a little bit about the risks, and we'll start doing so on the next page, please. Thank you. So there have been some press reports about a little bit of froth in the market, and these are some categories, particularly to the right-hand side, of equity names or equity categories that we find to be generally speculative. Whether it's unprofitable tech or meme stocks in particular, we're showing some pretty startling positive returns year to date and over the last 3 months. So there may be a little bit of froth in some of the more speculative areas, but I would point out that some of that froth might be coming out kind of as we speak. Palantir is a fairly well-known company at this point in time, and I wouldn't impugn it by calling it speculative, at least not in terms of the business that it does, which is very real, nor in terms of the growth rate of its earnings per share, which is around 50% at the current pace. But at 200 times forward earnings, well, the market may be getting a little bit ahead of itself, and that may explain why this week, even though it reported rather stellar earnings, it's down a good 15% from its all-time high. And frankly, that sort of gentle air coming out of a frothy part of the market is healthy overall. It's the pause that should allow for another leg higher. And legs higher, if they come, are going to come on the back of earnings, which, as we show on the next slide, are projected to grow really quite nicely. And they have been growing nicely. If you look at the Q3 estimate, this was written a couple of days ago, and it's at 11% year-over-year growth, as you can see on the page. However, after just the last 2 days of additional earnings, that growth rate is now at 13%. Now, that's very good. It is, however, reflective of a quarter that ended September 30th. And if we're going to continue to get the growth numbers that we see here, it can't all be on the back of the artificial intelligence stocks. The rest of the market is going to have to show earnings growth, and that will be difficult to do if this government shutdown continues. Now, Amita mentioned the government shutdown, and I've mentioned it twice. I will certainly admit that when it started, Amita, many of us said, no big deal. These on average last 8 days and don't have an effect. Well, 37 days into this shutdown and counting, it is clearly having an effect. And we see that in the reports, earnings reports from discretionary companies like Chipotle and Starbucks. If we don't pay a sizable portion of the population their salaries for a month, month and a half, and I'm not just talking about furloughed workers who work for the government, I'm talking about contractors who haven't gotten paid, and so they have to pull back on the compensation to their employees as well. If we do that for a month and a half, I say this with no sarcasm, it gets harder and harder to buy a Chipotle burrito. And continuing on this theme, if we get to the point that we have reached today where the Department of Transportation says we're going to have to curtail flights by 10% at 40 of the top major airports, that is going to have a bad effect on the earnings for airlines. It also is going to have a bit of a dampening effect, as I think we've seen the past few days, on market sentiment. So I won't beat the drum any further. I will simply say that opening the government is potentially an important tailwind, but until it happens, it's a risk to the markets. Let's continue on with this discussion of risk versus opportunity. Very often at Cerity Partners, we hear commentators, clients, people asking, isn't the market too expensive? And there are indicators that are often used to portray that point, like the Case-Shiller price-to-earnings multiple, or the what's called the Warren Buffett indicator, which is the value of the stock market relative to the GDP. However, what I would suggest is if you look at, second from the right, the S&P 500 cap-weighted, which is the headline index, currently trading at 23 times forward earnings. Yes, it is a little bit on the high side compared to its 10-year range, but it is probably justified by those growth rates that we showed on the prior slide. And very importantly, if you strip out the top of the market, that 40% of the S&P 500 cap-weighted index that is the 10 largest names, and if you look instead at the average stock, which is measured by the S&P 500 equally weighted index, the second from the left, you can see that the multiple comes down significantly and is right in the middle of its 10-year range. The point of this is to say that yes, you can certainly find indicators that show the market is expensive, and you can find indicators that show the exact opposite. What we believe at Cerity Partners is that once the government shutdown ends, that there is a reasonable chance on the back of Federal Reserve further rate cuts that the rally will broaden and these cheaper sectors of value stocks, equally weighted S&P 500 and small caps can rally. What is also a risk that we haven't talked about, but we must, is credit. Now, on the next slide, we're going to hit some provocative headlines. There have been some significant bankruptcies in the corporate world over the last couple of months. I do want to stress the subheading in this chart. We are not crying fire in a crowded room. We're simply paying attention. The number of these bankruptcies is not so large yet that makes us think that there is something more pestilent than just a few. And there have been a lot of reports that particularly in the private credit space, by far credit quality is quite high and that credit standards are not only being upheld, but due diligence is being enhanced to make sure that nothing like what we've seen so far in terms of subprime auto lenders collapsing metastasizes into what happened in 2007, where the two hedge funds that blew up at Bear Stearns were a premonition of worse things to come. So in terms of whether what has happened the past month or not might be a premonition, what are we looking at? Well, importantly, we're looking at credit spreads, which we show on the next slide. And those credit spreads show clearly that there is not a systemic problem in credit. We're watching this on a daily basis, but this chart shows that the bond market does not feel that there is a systemic credit risk ahead. If we also look at what banks themselves are saying on the next slide, I know this is a fairly bowl of spaghetti-ish looking chart, but really what it's showing is various types of consumer loans and what's happening to the delinquency rates of those loans. And what you're seeing in this chart, which obviously goes back over 20 years, is that when the pandemic hit, all the stimulus money that came to consumers allowed them to pay off their various forms of credit, whether it's credit cards, auto, mortgage, HELOCs, student loans were paused, as we know, and that allowed the delinquency rates to come back down. Now, starting in 2023, we saw delinquency rates creep up. We do at Cerity Partners have an equity program that pays attention and listens to company earnings calls. Importantly, we listen to the bank earnings calls, which always start out the quarter. And for several quarters, bank managements, the CEOs and chief financial officers have been saying that this rise in delinquencies that you see from 2023 to the current date is simply a normalization of credit delinquencies after the abnormally low rates during the pandemic. And you can even see, for instance, if you look at credit cards, that not only has the delinquency rates normalized, but they've started to come down a little bit as well. So every indication from the banks is that yes, credit is in good shape, particularly at the consumer side. Now, of course, the student loan matter does need to be addressed. It's spiked higher, but there are the idiosyncratic reasons there that payments were suspended for almost 4 years. And it has taken the consumer some time to adjust to the fact that student loan payments have restarted. We'll keep an eye on this. We don't like to see a spike in credit delinquencies like that, but it may well be explained by the suddenness of student loan payments being restarted. I think our last slide is just to address what's going on with currency. And I say currency even though what I have up here are alternate forms of currency such as gold and Bitcoin. But this year has been a year where the sacrosanct nature of the US dollar, the risk-free status of US treasuries have been questioned. And that has been shown certainly in the rapid rise in the price of gold to over $4,000 an ounce. It has since come back somewhat. We were thoughtful that perhaps, just perhaps, Bitcoin would act as a 21st century version of gold and show a similar hedging ability. Unfortunately, that hasn't been the case. Bitcoin has tracked pretty much in line with the equity markets. It goes up during good times, comes down when risk off hits the markets. But I think the overall message from this is that while there are concerns about the U.S. Standing in the world, whether as measured by trading partners, the sanctity of the dollar, the risk-free nature of the treasury market, that it is not necessarily going to crescendo from here. We see gold has come off. And for many clients who are wondering, geez, should I have gold in my portfolio? Should I have Bitcoin? I want to remind you that while these returns are very good, so have been the returns in the stock market. Whether it's international, whether it's the S&P 500, whether it's small caps, whether it's technology stocks. What you feel you may have missed in a gold rally, you most likely have made up for in the equity portion of your portfolio. We do continue to keep an eye on this as a potential risk, but at the moment we see the concerns about the sanctity of the US dollar and US Treasury markets easing. With that, I think that draws to a close. This is our overall outlook for the economy and the markets, which is to say we see a very low chance of a recession. As I already mentioned, we see the Fed cutting rates. We see the one big beautiful bill being stimulative. That is what Amita pointed out quite eloquently. And we do expect, with the government shutdown hopefully coming to an end soon, that the market can broaden in its rally and make the equal weight S&P 500 show perhaps a little better performance than the market cap weighted S&P 500. With that, I want to thank you. Amita, Tom, and I want to thank you for joining us. I hope you've found this helpful. Tom, do you have any final words?
No, I'll wrap up. Tremendous job, Jim and Amita, as always. If there are any follow-ups from everything we covered today or anything we didn't cover today, please reach out to your Charity Partners advisor. And again, you could find more information on any of the topics we covered on our website. A copy of the recording and the presentation will be available early next week. Want to thank you so much for your time and for your support. Have a good afternoon, everyone.